XRP just hit $3. Everyone's celebrating. Twitter is exploding with people posting their gains. Your group chat is going crazy. Someone just turned 5,000 into 50,000 in 2 months, and you're sitting there thinking, should I buy some? Am I missing out? Everyone's making money except me. Here's what nobody's telling you. That feeling you're experiencing right now, that FOMO, that urgency, that fear of being left behind, that's not investment strategy. That's mistake number 2 on a list of 7 mistakes that have cost investors not just money, but decades of wealth accumulation. Mistakes that have turned potential millionaires into people still working at 70. And by the end of this video, you'll understand exactly why chasing XRP, or any asset you don't understand, is financial suicide. Stay until the end, because mistake number 7 is the one that destroys more wealth than all the others combined. Before we dive in, I need to be crystal clear about something. This video is not financial advice. I'm not telling you to buy anything or sell anything. This is education. This is about understanding the patterns that destroy wealth so you can avoid them. And if you're here for quick tips on how to get rich overnight, you're in the wrong place. Because that's not how wealth works. That's how people go broke. This channel is about real wealth-building principles. The boring stuff that actually works. The strategies that billionaires use but nobody talks about because they're not exciting. There's no hype here, no promises of overnight success, just decades of market history, real data, and principles that have stood the test of time. If that's what you're looking for, hit that subscribe button right now, because every video on this channel is designed to help you avoid the traps that keep 90% of people broke forever. Now let's get into the 7 investment mistakes that cost decades of wealth, starting with the one that most people never even consider. Here's the first mistake, and it's the foundation for all the others. Most people think they need to learn from their own mistakes. They think experience comes from trial and error, from losing money and figuring it out as they go. And that approach will cost you decades, because here's the reality. Every mistake you could possibly make has already been made by someone else. Every bubble, every crash, every fraud, every panic sell, every FOMO buy. It's all been done before, and the patterns repeat with stunning consistency. The South Sea Bubble in 1720, the stock market crash of 1929, the dot-com bubble in 2000, the housing crisis in 2008, the crypto mania in 2021, different assets, different decades, same human psychology, same mistakes, same devastating results for the people who didn't study history. Let me give you a specific example. Enron. In the late 90s, it was one of the most respected companies in America. Fortune magazine named it America's most innovative company for 6 consecutive years. The stock went from $10 to $90. Analysts loved it. Investors poured money into it. And then in 2001, it came out that the entire thing was built on accounting fraud. The stock went to zero. Thousands of employees lost their retirement savings. Institutional investors lost billions. Now here's the key question. Did you need to lose your own money in Enron to learn that lesson? Or could you study what happened and understand the warning signs? Creative accounting, excessive complexity, leadership selling shares while telling employees to buy more. Those patterns show up over and over in fraudulent companies, and if you study them, you can spot them before you lose money. The same thing happened with Lehman Brothers in 2008, with Bernie Madoff's Ponzi scheme, with countless pump and dump schemes in crypto. The patterns are always there. Unrealistic returns, lack of transparency, pressure to invest quickly, fear of missing out. These are the red flags that repeat in every financial disaster. So here's your action step for mistake number 1. Commit to reading one investment disaster case study every month. Enron, Lehman Brothers, long-term capital management, the dot-com crash, the housing bubble. Study what went wrong. Understand the psychology. Recognize the patterns. Because the investors who study history don't repeat it, the ones who ignore history, they become the next case study. This brings us to mistake number 2, and this is where XRP comes back into the story. Buying what you don't understand is not investing, it's gambling, and the market is designed to separate gamblers from their money as efficiently as possible. Here's the test. If someone asks you about your investment, can you explain how it makes money in one clear sentence? Not how the price might go up, not what other people are saying about it, but how the actual underlying asset generates cash flow or value. If you can't do that, you don't understand it. And if you don't understand it, you shouldn't own it. Let's use XRP as an example. Do you know what XRP actually does? Do you understand the business model of Ripple Labs? Do you know how they generate revenue? Do you understand the difference between XRP, the token, and Ripple, the company? Do you know why banks would or wouldn't use it? Do you understand the regulatory environment and how that affects value? If you can't answer those questions clearly, you don't understand XRP. You're not investing in it. You're speculating on it. You're hoping the price goes up because other people are buying it. That's not a strategy. That's a gamble. And gamblers eventually lose. Now I want to be very clear. I'm not saying XRP is good or bad. I'm not telling you to buy it or avoid it. What I'm saying is this: if you can't explain how your investment creates value, you're flying blind. And flying blind in financial markets is how people lose everything. There's an investor who became a billionaire by age 75 after 60 years of disciplined investing. And you know what he said about tech stocks in the 90s? He passed on them, passed on Amazon, passed on Google early on. Not because they were bad companies, but because he didn't understand them well enough to invest with confidence. And you know what else? He avoided massive losses during the dot-com crash because he wasn't holding things he didn't understand. Here's the uncomfortable truth. It's better to miss out on a winner than to lose money on something you don't understand. Because the winners you miss don't cost you anything. They just pass you by. But the losers you hold because you didn't understand them, those cost you real money, real wealth, real decades of compound growth. So here's the rule. Before you invest a single dollar, write down in one sentence how that investment makes money. If you can't do it, don't invest. And if someone tries to pressure you by saying you'll miss out or everyone's doing it, that's a sign to run in the other direction. Because real investments don't need hype. They have fundamentals. Mistake number 3 is being in a hurry. And this one destroys more potential wealth than almost anything else because it's based on a fundamental misunderstanding of how wealth actually builds. People think wealth comes from finding the right stock at the right time, from timing the market perfectly, from getting in early on the next big thing, and that approach might work once, maybe twice if you're lucky, but it doesn't build lasting wealth. What builds wealth is time plus compound interest plus patience, and most people don't have the patience. Let me show you the math that changes everything. If you invest $10,000 at a 20% annual return, here's what happens. Year 1, you have $12,000. Year 5, you have about $25,000. Year 10, you're at $62,000. Still not life-changing money, and this is where most people quit. They say, "I've been investing for 10 years and I'm not rich yet. This doesn't work." But here's what they miss. Year 20, that $10,000 becomes $380,000. Year 30, it's $2.3 million. Year 40, it's $14 million. Year 50, it's $91 million. Year 60, it's $567 million. From $10,000 to over $500 million. That's the power of compound interest over time. But you have to stay in the game. You have to resist the urge to get rich quick. Because every time you chase a hot tip, every time you try to time the market, every time you jump from strategy to strategy, looking for faster results, you reset the compound clock. You pay fees, you pay taxes, you lose momentum, and you end up with nothing. Here's a real example. Day traders. Studies show that over 95% of day traders lose money after accounting for fees and taxes. 95%. Why? Because they're in a hurry. They're trying to make fast profits. They're trading constantly, and the fees and taxes eat them alive. Meanwhile, someone who bought an S&P 500 index fund 30 years ago and did nothing, they've averaged about 10% annual return. Their money has multiplied by over 17 times, not by being smart, not by being active, just by being patient. The stock market has returned roughly 10% annually over the past 100 years, through the Great Depression, through World War II, through the oil crisis, through the dot-com crash, through 2008, through COVID, 10% average over a century, but only if you stay invested, only if you're patient, only if you're not in a hurry. So here's the truth you need to accept. Building real wealth takes decades, not weeks, not months, decades. And if you can't commit to that timeline, you're not investing, you're gambling. And the house always wins when you gamble. Mistake number 4 is misunderstanding diversification. And this one is tricky because everyone tells you to diversify, but almost nobody explains what that actually means or why you're doing it. Here's what most people think diversification means. Own as many different things as possible so if one goes down, the others protect you. So they end up with 50 stocks, 100 stocks, 15 mutual funds, 3 crypto coins, some bonds, some real estate investment trusts. They own a little bit of everything, and they think they're being smart. But here's what they actually have: a diluted, mediocre portfolio that mirrors the market average but costs more in fees. They own everything, which means they own nothing with conviction, and their returns are average at best, minus the extra fees they're paying for all those holdings. Let me tell you what actual wealthy investors understand. Diversification is protection against ignorance. If you don't know what you're doing, yes, diversify broadly, own an index fund and call it a day. But if you actually understand businesses and you've done deep research, concentration beats diversification every single time. Warren Buffett's Berkshire Hathaway made its fortune by concentrating in a handful of well-understood businesses: Apple, Coca-Cola, American Express, Bank of America. Not 50 companies, not 100. A focused portfolio of businesses they understood deeply and held for decades. Here's the principle. If you've found 6 to 12 exceptional companies with durable competitive advantages, companies you understand completely, companies you'd be happy to own for 20 years, that's enough diversification. More than that, and you're just watering down your returns. But, and this is critical, if you don't have the time, knowledge, or interest to deeply research individual companies, then a low-cost index fund is your best friend. One fund, one investment. Own the whole market. Let it compound for decades. That beats 90% of professional money managers over long time frames. The mistake is the middle ground, owning 30 or 40 or 50 individual stocks that you don't really understand because someone told you to diversify. That's not diversification, that's confusion. You're paying attention to too many things. You can't possibly understand them all. You're paying unnecessary fees, and you're guaranteeing mediocre returns. Here's the test. For every stock you own, can you explain the business model, the competitive advantage, and why you'd hold it through a 50% crash? If not, you shouldn't own it. Either narrow your portfolio to what you truly understand or simplify into index funds. The middle ground costs you decades of wealth. Mistake number 5 is ignoring fees and taxes, and this one is invisible until you do the math. Then it's devastating. Let's run a real comparison. Two investors, both start with $10,000. Both invest $10,000 more every year for 30 years. Both earn 10% annual returns before fees. But investor A uses a low-cost index fund with a 0.04% expense ratio. Investor B uses an actively managed mutual fund with a 1% expense ratio. After 30 years, investor A has about $1.8 million. Investor B has about $1.5 million. Same contributions, same returns before fees, but investor B paid $300,000 in fees over 30 years. $300,000. That's not a small difference. That's a house. That's early retirement. That's generational wealth. Gone. Evaporated into management fees, and it gets worse when you add taxes. If you're trading frequently, selling winners to lock in gains, you're paying capital gains taxes every year. Short-term gains are taxed as ordinary income. That could be 30 to 40% of your profit, gone, every year. Compare that to someone who buys quality investments and holds them for decades. Their gains compound tax deferred until they sell, and when they finally do sell in retirement, they pay long-term capital gains rates, which are much lower. The difference in after-tax returns over 30 years is staggering. Here's a real example from the research. The average actively managed mutual fund charges about 1% in fees and generates enough trading to create tax drag of another half to 1% per year. So you're giving up 1.5 to 2% annually. Over 30 years, that cuts your ending wealth by 30 to 40% compared to a low-cost, tax-efficient strategy. Think about that. Same investments, same time horizon. But one approach leaves you with 40% less wealth just because of fees and taxes. That's not a rounding error. That's the difference between a comfortable retirement and working until you die. So here's what you need to do. First, calculate what you're actually paying in fees. Look at your mutual funds. Look at your advisory fees. Look at your trading commissions. Add it all up as a percentage of your portfolio. If it's over 1%, you're bleeding wealth. Second, minimize trading. Every time you sell a winner, you trigger taxes. Every time you buy and sell frequently, you pay fees. The more you trade, the less you keep. The goal is to buy quality and hold forever. Let the compound interest work. Let the gains defer, and keep your money instead of giving it to fund managers and the IRS. Mistake number 6 is letting emotions drive your investment decisions. And this is the hardest one to fix because emotions are hardwired into us. Fear and greed aren't bugs. They're features of human psychology. but they're terrible guides for building wealth. Let me show you exactly how this plays out. March 2020. COVID hits. The stock market crashes 34% in 5 weeks. Fastest crash in history. And what did most people do? They panicked. They sold everything. They went to cash. They swore they'd never invest again. That was fear. Now, what did Warren Buffett and Berkshire Hathaway do during that same crash? They bought. They deployed billions into quality companies at discount prices, and within a year the market recovered and hit all-time highs. The people who sold in fear locked in massive losses. The people who bought during fear made fortunes. Now flip to 2021. Crypto is exploding. Meme stocks are going parabolic. GameStop, AMC, Dogecoin. Everyone's making money. Your coworker turned 5,000 into 50,000. Social media is full of people posting gains. And what did most people do? They jumped in. They bought at the top. They FOMO'd into assets they didn't understand. That was greed. And what did Berkshire Hathaway do? They sat on over $140 billion in cash. They refused to overpay. They waited. And when those speculative bubbles popped, they had dry powder to deploy into real value. The people who chased greed lost everything. The people who resisted greed preserved wealth. Here's the pattern. Your emotions tell you to sell when things are scary and buy when things are exciting. And that's exactly backwards. The best time to buy is when everyone is terrified. The best time to be cautious is when everyone is euphoric. But doing that requires overriding your instincts. And most people can't do it. So how do you fix this? You don't fight emotions in the moment. You plan around them in advance. Here's what successful investors do. During calm times, when the market is normal and emotions are low, they write down their rules. Clear. Unemotional, specific. Rules like, I will never sell during a market crash. I will not buy anything without understanding it first. I will invest a fixed amount every month regardless of market conditions. I will not check my portfolio more than once per quarter. I will not act on financial news or social media hype. Then when emotions hit, when the market crashes, or when FOMO strikes, you don't make decisions. You follow your rules. You've already decided what to do. You wrote it down when you were calm. Now you just execute. This is how you beat emotion. Not by being smarter, not by being tougher, but by removing the decision from the emotional moment. You decide once, during calm, and then you stick to it during chaos. The investors who do this build wealth. The ones who decide in the moment based on feelings, they get destroyed. And this brings us to mistake number 7, the one that destroys more wealth than all the others combined: quitting too early. Here's what happens to most people. They start investing. They're excited. They put money in. They read articles. They check their portfolio. And after a year, they've made maybe 8 or 10%. After 2 years, maybe they're up 20% total. After 5 years, they might have doubled their initial investment if they're lucky. And they look at those numbers and think, this is it? I've been doing this for 5 years and I'm not rich. This is too slow. There has to be a better way. So they quit. They pull their money out. They try something else. They chase the next strategy. And they reset the compound clock back to 0. What they don't understand is that compound growth is exponential, not linear. It starts slow, painfully slow. For the first decade, it feels like nothing's happening. But if you stick with it, if you keep investing consistently, if you don't quit, the growth accelerates. And by year 20, by year 30, the numbers become absurd. Let me show you with real data. The stock market has averaged about 10% annually over the past 100 years. That includes the Great Depression, World War II, stagflation in the 70s, Black Monday in '87, the dot-com crash, the financial crisis, COVID, everything, 10% average. But only if you stayed invested the entire time. If you jumped out during crashes, if you tried to time the market, if you quit when it got boring, your returns were probably closer to 3 or 4%. Because you missed the recovery days, you missed the compound acceleration. And over 30 years, the difference between 10% and 4% isn't small. It's the difference between wealth and mediocrity. Here's the brutal truth. Most people who start investing quit within 3 to 5 years. They get impatient, they get scared, they get distracted by something shinier, and they never see the exponential phase of compound growth. They plant the tree, but they pull it up before it bears fruit. The people who build real wealth, they pick a boring, proven strategy and they stick with it for 30, 40, 50 years, through crashes, through bubbles, through boredom. They don't quit. And by the end, they have millions while everyone else is still searching for the secret. There is no secret. There's only persistence. Time plus consistency plus patience equals wealth. But you have to stay in the game. You have to survive the boring years. You have to resist quitting when it feels pointless. Because the rewards don't come in year 5, they come in year 30. And if you quit at year 5, you get nothing. So here are the 7 investment mistakes that cost decades of wealth. Learning from your own mistakes instead of studying history. Buying what you don't understand. Being in a hurry. Misunderstanding diversification. Ignoring fees and taxes. Letting emotions drive decisions. And quitting too early. Every single one of these mistakes is avoidable. Not through luck. Not through genius. Just through discipline, education, and time. The path to wealth isn't complicated, it's just not easy, and most people quit before they get there. If you found value in this video, subscribe right now, because this channel is about cutting through the hype and giving you real principles that actually work. Drop a comment and tell me, which of these 7 mistakes have you made? Let's learn from each other. And remember, there are no shortcuts. There's only the long, boring, proven path, and that path works. See you in the next one.